Everyone has a trading opinion, but what does the data actually say? In this video, we'll use Python to explore historical stock trends, visualize patterns, and identify behaviors that separate good trades from bad ones. No fancy algorithms or machine learning models, no hype, just simple exploratory data analysis that helps you make data-driven decisions. Once you understand the data, trading strategy design becomes crystal clear. That being said, my objective for today is to use Python to perform exploratory data analysis on the hourly chart of the SPX index to see if there are any trading patterns we can use to trade intraday. Before we start, I would like to put a disclaimer that this is not a solicitation to buy any financial products or investment, and this is just me sharing some ways of using Python to uncover possible trading patterns or strategies. Now, without further ado, let's jump right in. As always, we start by importing the necessary libraries. We will need yfinance to extract historical stock prices, and we will use Seaborn and Matplotlib for visualization. Once we have imported the libraries, we start by defining the time period of the data we would like to extract. Naturally, we want the latest data, hence the last date would be the current date. As we are looking at intraday trading patterns, hence the time interval we need from yfinance is the hourly data. For hourly data, yfinance has a limitation, as it only stores the last 720 days, or somewhat equivalent to 2 years worth of hourly data. Hence, I have defined the start date as 720 days prior to the current date. Then, we will define the ticker to SPX, as that is the ticker of interest, and use the yfinance download function with the necessary input variables to get the data we need. We can then view the result. Looking at the data, we would see that the column headings are multi-indexed. We will format the column headings to make it look better. Then, using the date-time column, we will use it to create a column populated with the dates without the time. We will use this date column later on to merge it with another data frame. Next, we will create a trading hour column. This column will serve as an index to indicate the trading hour for the day. We will do a group by on the date column, and use a cumulative sum function to create the cumulative indicator in order. We will increment the trading hour by 1 to make it more intuitive, as Python starts the count with 0 instead of 1. We will also rename some of the column names to sound more intuitive, and we can output the result to take a look as well. There, this looks much better. However, having only the open, close, high, low prices with the volume is insufficient to detect hidden trading patterns. We would need to create features derived from the current available data to do so. We will start by creating 2 percentage change columns. The first would be the percentage change between the opening price for the hour and the closing price for the hour within the same day. The second would be the percentage of difference between the highest and the lowest price for the hour. Next, we will download the daily data for SPX index. We need the daily close data to be joint with the hourly data that we have prepared. Same as before, we will process the column names. Once that is done, we will merge the data frames. Now, we have the days open and close along the same row as each trading hour. Once the tables are combined, we can start to do some simple exploratory data analysis. We can start by analyzing the data distribution of volatility per hour, measured by the difference between the high and low price for each hour. We can do a group by of the trading hour, and apply the describe function on the column high-low hour difference. Looking at the summary description, we would notice that the count from the first to the third trading hour is higher compared to the fourth till the seventh. This is most likely due to holidays, where the market only trades for 3 hours instead of the usual 7 hours. The next thing we would notice from the table is that on average, which is the mean, the first hour is the most volatile, followed by the second hour. Moving on to the next column, which is the standard deviation, we can see that the first hour has the greatest variability of volatility, with a wide range of high and low price differences from 0.087 at a minimum to a maximum of 8.31. This is further confirmation that the first trading hour is the most volatile. The second highest variability of volatility would be the fourth hour, with a minimum of 0.07 and a maximum of 6.99. This is interesting, as this result diverges from the second highest mean volatility, suggesting that on average, the second trading hour is generally more volatile compared to the fourth trading hour, but the range of volatility in the fourth hour is greater than the second hour. However, the range of volatility in the fourth hour could be due to outliers, as from the various percentile ranges, we can see the values for the second hour being higher than the fourth hour. Another thing we might observe is that the mean across the trading hours are higher than the median, or the 50th percentile. This means that the distributions are positively skewed with a right tail. We can confirm this in the form of a box plot to observe the distribution visually. There are indeed outliers across all the trading hours. From a simple feature created, we are able to observe so much information from a basic exploratory data analysis. We can try this out on different features to see what other additional insights we can glean to uncover trading patterns. Once we have done the exploratory data analysis, we can use the information we have learned to develop trading hypotheses. For now, let's assume we have some idea that for some trading hours, if the closing price is higher than the day's opening price, the day's closing price will end higher than the closing price for that trading hour, and that this is also true for the reverse in terms of closing price lower. This implies that the direction of the trading hour's close price relative to the day's opening price has some predictive power as to the day's closing price. We can add an additional column to show the result of it. Let's first create a column to measure the percentage difference of the hour's closing price from the day's opening price. Then, we'll code out the above hypothesis using the numpy-where function, with a Boolean output, 1 to indicate yes the relationship holds true, and 0 if it is not. As before, we can display it in a box plot to see the results visually. From the display, we can see that generally across the trading hours, it is a positively skewed data distribution, and there is no clear edge for the hypothesis to hold true. We can also check the aggregated mean of the hypothesis values, and it confirms that there is not a significant edge across the various trading hours, with most of the values hovering about 0.5. There is no difference between this hypothesis and a coin toss. Although the results are not ideal, at least we are able to develop some views based on our hypothesis findings. Next, we will need to backtest the trading strategy based on the findings. To do so, we will simulate having a portfolio and monitor the performance of it by applying the trading strategy over a period of time. We will create a function that takes in 4 inputs: the trading hour, hypothesis, profit and loss amount. We will first instantiate a data frame based on the input trading hour and hypothesis, along with a predefined starting time to perform the backtest. In this case, I have selected the start of the year 2025 till date as of the current date during the code as the backtest period. You may change and vary this accordingly. Next, I will compute the profit and loss of each day based on the predefined input value of profit for a profitable trade and loss amount for a losing trade. Assuming a starting portfolio of $100, I will sum the profit and loss cumulatively across the days, and this will be populated as a new column portfolio, which will indicate the portfolio value for each day. Then, we will plot the line graph of the portfolio value across the backtested time period. Now, let's test a hypothesis out. Assume we are trading options, and so we are interested in only the price movements. Based on our previous assessment, for the first trading hour, on average there is a slight edge in the day closing in the same direction as the direction of the difference between the day open price and the first trading hour closing price. Thus, we can input the first value of 1 for the trading hour. Since we are betting that the direction move of the difference between day open price and the first trading hour closing price will indicate the price movement direction of the day closing price, we can set the hypothesis input value to 1. Next, we will assume a symmetrical return for profit and losses, and thus will set the values as 10 and -10 respectively. We can run the function and view the plot of portfolio value over time. From the plot, it seems that our hypothesis is spot on, and this trading strategy is profitable. Over a period of close to 10 months, trading this pattern will result in approximately 250% return. Does this mean we should rush to implement this trading strategy since the backtest shows such fantastic results? No, because the previous backtest results were based on assumptions which might not necessarily hold true in the real world. For example, in the previous backtest, we assumed a symmetrical profit and loss profile, which may not be valid in the real world. We can do a sensitivity analysis by simulating a scenario where each loss is twice the profit we make. Are we still be profitable? From the chart, it is clear that this is a loss-making situation, and serves as a reminder that when we make simulations, we are relying on assumptions that may not hold true in the real world, and we have to be mindful of it, and not think that what we simulate will translate into the real world. We can test out a last hypothesis before we end. Based on the hypothesis assessment done previously, we can see for the 5th trading hour, there is a slight edge in the day closing in the opposite direction as the direction of the difference between the day open price and the first trading hour closing price. We will test it out by inputting the values as shown. We will assume a symmetrical profit and loss. From the chart, we can see that it is profitable as well in the simulation. In conclusion, we have gone through a few hypothesis testing based on what I think are possible trading patterns based on simple exploratory data analysis, along with backtests to assess the results. These are simple hypotheses, but feel free to create more complicated features and discover more trading patterns or strategies with a better edge. Additionally, backtests are important references to test the efficacy of the hypotheses, but they are based on assumptions which may not hold true in the real world. It is vital to be aware of the backtest limitations so that you are not disappointed when what you simulated doesn't happen in reality. And that's the end. Hopefully this has been helpful to you. For those who are interested, I will be sharing the link to my notebook in the description section of the video. Do you have any thoughts on it? Feel free to comment in the comment box down below. If you liked this video and would like to see more content of this nature, please be sure to like and subscribe as well. Thanks for watching, and until next time.